All right. Well, thanks so much, Lori. And thank you, everyone who's joining us today. Again, my name's Jeff Dickerson, and just a little bit of background about myself. I've actually worked with Slavic for about 22 years. It was my first job right out of college from Florida Atlantic University in Boca. And I work with Lori and consult with her companies as far as, if they have an existing plan, talking about, plan design, plan transfers, and so forth. Our whole, goal is providing the best type of product that's available for the company as well as their employees. And then we also have representatives like myself that are, scattered throughout the country, and they also do similar roles. But my title, like with the company, is the Vice President of the Registered Representatives. So I pretty much oversee all the different representatives within the different regions. And I know many of you are probably not familiar with Slavic, but we're named after John Slavic. He's the president of the company. So we're not an Eastern European investment firm like many would assume that we are. But John Slavic actually founded the company over 30 years ago, and it's based in Boca Raton, Florida. And he started off as a regular broker-dealer business and then started a 401k administrative side. So over the years, what they've created is what's called a bundled 401k platform. And through that bundled 401k platform, we serve as the third-party administrator. So we're doing all the boring stuff behind the scenes that the IRS requires, but we're also the custodian or record keeper for the plan and the accounts, as well as an investment advisor to the plan. And kind of through that bundled approach, we're able to usually offer 401k plans at lower costs than regular providers that, someone might have a local third-party administrator, they might have Fidelity as their custodian, then they've got a broker who's their investment advisor. So they're often dealing with, three different parties. But by having a bundled approach, it usually creates a more streamlined as well as lower overall investment fees. And kind of through that, bundled approach, we've actually kind of had one area that we focus on, which is what's called the PEO or professional employer organizations. Companies like Excel, that's our entire niche market. We focus to provide 401k services to companies like Excel throughout the country. And they'll sponsor what's called these multiple employer plans or MEPs. And I'll kind of be explaining that whole concept later. But there's very few companies in the country that actually kind of focus on this type of 401k administration. But through this relationship, we manage over $5 billion in assets. And through these types of plans, we actually have over 7,000 companies that are participating that we're doing plans for, and over about 160,000 participating employees. So, people might not be familiar with Slavic, but again, that's because we don't focus to any individual companies, but the investments within the plan, those are Vanguard, Fidelity, American funds, and so forth. And, the people who are joining us today, some of you might have an existing 401k plan. Some of you might have, never had a plan. So we did want to kind of just cover, 401k basics, as well as kind of the different components that are part of and necessary for 401k plans. So, some of this is going to be a review, some of this might be brand new, but hopefully it's going to be pretty easy to follow and understand. But as far as a 401k, it is considered a qualified retirement plan. And when the IRS was writing down all their laws and tax codes, they came to 401, and it's basically the code section that says, okay, a company can provide this type of a retirement plan for their employees. And so there's a lot of rules and regulations that go on within these plans, but they'll have tax advantages by participating to 401k plans, that people don't have with regular savings or regular brokerage accounts. And it'll allow your employees, to be putting aside and saving money, automatically through their payroll. So it's an easy way to be saving their money. But it also allows companies to contribute. So it's voluntary. There are certain plan designs that might require an employer contribution, but essentially, the company is able to choose its plan design, but, by choosing that plan design, you might have an option for matching, profit share, and so forth. But anytime a company is making a contribution to these types of plans, it is a tax deduction for the company. So a lot of times, if companies are used to doing end-of-year bonuses to the employees, well, you'll have the payroll taxes associated with that, the FICA, the FUTA, the SUTA, the workers' comp. Whenever contributions are made to these qualified retirement plans at the employer level, there's no payroll taxes on that money. So it's a win for the employer, and it's also really a win for the employee because they don't have any payroll taxes on that money. And the company is able to get that tax deduction for the business. And as far as like some of the rules that the IRS, puts in place with the 401k plans, one of those is, well, how much can you contribute and save each year? And what they allow is employees are able to put aside, up to as much as $19,000 or as much as $25,000 of their income each year if they happen to be age 50 or older. And nowadays, there's actually two ways in which employees can contribute. They'll have the Roth method and the traditional method. The traditional used to be the only method available, and that's where the money is pre-taxed and it grows tax deferred. So they avoid the taxes on the money when it goes in, but they pay taxes on all of it when they withdraw it. The Roth option works the opposite of that. If the employee chooses the Roth method, that money that the employee contributes and saves, no immediate tax benefit, so they're still paying regular taxes on that money. But when they take that as a distribution, everything that they've contributed plus the growth on that Roth money, that portion of their account will be completely tax-free. So in this plan, employees are able to, choose how much they'd like to save as well as the method that they would like to be contributing. But then from an employer perspective, employers can choose if they would like to do a matching contribution to those employees who participate. You're welcome to do a matching formula. And then companies can also do profit share where, really, hey, at the end of the year, if the company has a good year, they can make a contribution. So it does allow, employee, and then the matching and a profit share. But together with all of these three contributions, an individual could actually have as much as $56,000 a year being deposited into their account, or even as much as $62,000, if they happen to be age 50 or older. So substantially greater contribution limits than someone would have with, a regular IRA or a Roth IRA. So if companies are maybe wanting to, offer the employees the ability to save more, and if the company is offering, maybe wanting to provide a benefit, an incentive, companies can choose to do those matching or profit share. So, a lot of room, but with these types of flexibilities and the tax benefits, it really is the #1 way in which Americans are saving and planning for their retirement these days. Now, to kind of explain a little bit on the employer side as far as contributions that companies are able to make, the first one is usually the matching contribution. And so there's what's called discretionary matching, where the company could say, oh yeah, we'd like to do a matching, to those who do choose to participate. But whenever a company is choosing to match, that's usually going to be an incentive. So, hey, yeah, if you contribute and save your money in your 401k, we're going to add X amount of dollars to your account for you. Well, they wouldn't be getting that money put into, an IRA or a savings account. So it is an incentive for the employees to be saving and planning for their own retirement. But employer contributions that are made to these types of plans through the discretionary match, you can also have that subject to vesting. Vesting refers to ownership. Anything that employees contribute and save of their income, they're always fully vested. So their money's always theirs. If they try change careers, go to work for another employer, they're certainly able to keep everything that they've contributed. But the matching that the company makes, you could have that subject to 3 years of service, 4 or 5, as many as 6 years before employees could keep all of what that company has matched them. So with vesting schedules, the employees are going to see that money in their account. They'll see what their total balance is, what their vested balance is. So with those vesting schedules, it can kind of serve as a motivation to, retain employees and reduce some turnover, promoting some longevity. And with those matching contributions being discretionary, it does allow each company to choose, would you like to match? And if so, what kind of formula would you like applied to your plan participants? So the formula does need to be the same with matching for all participants. But just to kind of provide an example, there's usually kind of a combination of a match. Like I'll say like a starter match might be a company matching, 25 cents on the dollar, or 25% on the first 4% of pay that an employee saves. So in that example, if an employee is saving 4% of their income, but the company's matching them 25% of that value, that equals a maximum employer contribution of 1% of the employee's pay. So if an employee makes $50,000 a year, the maximum that that employee would receive would be $500, or 1%. Even if the employee wanted to save $19,000, they could do that. That matching formula just wouldn't exceed 1%. So it's kind of easy to, anticipate, based on a company's annual payroll. If we had 100% of the employees on the payroll signing up, the maximum that that formula would be 1% of payroll. So, these kind of formulas, they allow us to kind of build in to kind of estimate, oh yeah, here's the maximum that these matching would be as a company's expense. But usually there might not be 100% employee participation, so it can reduce it. So matching really, it's not as much as many companies might initially think it would be. But that would be kind of an example of a starter formula. Kind of on a common basis, many companies out there, after they've been having a plan in place for a number of years, about the most common match these days is 50 cents on the dollar, or 50% on the first 6% of pay. So in that formula, if an employee is saving 6% of their income, the company's matching 50% of that value, which equals a 3% maximum. So, kind of 3 to 4% is kind of national averages these days for company matching. So that's one way in which companies are able to contribute to these types of plans. But another method is through the profit sharing option. And profit share is a little bit of a misnomer. It actually has nothing to do with company profitability, but it just allows a company, if they would like to, hey, we had a good year, we'd like to allocate X amount of dollars to the retirement plan. And you have up until you file your corporate tax return to actually decide, would you like to make that contribution? If so, how much you would like to make that. So that gives your CPAs and your accountants plenty of time to say, hey, you were profitable this year. You might want to look at, offloading some of those profits to get a tax deduction and not have to pay so much in taxes each year. So you've got quite a bit of time as far as deciding if you'd like to do that. But again, it's optional each year. But one difference between profit share and a match is profit share, that's actually going to be allocated to everybody who is eligible. There's going to be a certain eligibility requirement that you put in place. It could be a year of service, 6 months of service, but anyone who has satisfied that requirement, they would receive that contribution. But it does go into their account, so it's not a cash, payment that you give them. But with that profit sharing contribution, putting into the retirement plan, it is the tax deduction. So, again, no payroll taxes and the company saves the money. But a lot of companies, they might motivate the employees through these types of methods, and that, internally they might communicate, hey, if we reach a certain goal or if we have a certain budget in mind, we might allocate X amount of that excess to the retirement plan. So there's certainly those things that can kind of be used to perhaps motivate employees, but again, there's never any, formal requirement. Hey, even if you made 100 million in profits, you don't have to do those types of profit sharing contributions. And those profit share, that's money that also can be subject to those vesting schedules. So you could have the 5-year schedule on those, a 6-year graded schedule. You could have that money immediately vested to the employees, as well as other conditions that say, hey, in order for us to, if we make that profit sharing contribution for 2019, you still have to be working as of December 31st of 2019 to be eligible. And there are different methods in which that money can be allocated. And that contribution, usually we'll talk to the companies each year. Okay, yeah, what is your goal in mind? Do you want to try and give everyone an equal percentage of compensation? Do you want to try and skew the benefit to maybe owners of the company, management, officers? There are some legal ways in which, not everyone has to receive equal amounts or equal percentages. I do have a chat that's popped up that we do want to mention that, we'll have a Q&A session after this, so anything that I'm talking about while we're going along, certainly we'll review these different sections, and then also we'll have this slide deck available to forward out to anyone who's interested. Okay, so with the discretionary profit share, discretionary matching that can be made, these are optional company contributions, but there are some testing that's performed within plans each year to make sure that employees didn't receive too much. And there's kind of 2 different tests that I'll explain to hopefully make this all very simple. But there's basically what's called highly compensated and non-highly compensated in 401k plans. And a highly compensated employee, is anyone who owns greater than 5% of the stock of the company, or if you happen to be a child or a parent or a spouse of the owner, or if you're an employee and you earn greater than 125,000 a year, you're considered a highly compensated employee. So you could be a business owner, pay yourself 60,000 a year, and you could have your spouse on the payroll at 30,000 a year. You're still both high comps. So, as long as you're an owner of greater than 5 or relative, regardless of your income, you're a high comp. And historically, it's the highly compensated individuals who have usually wanted to save, the most amount of money. But the IRS kind of discriminates against highly compensated employees in these plans. And the way that they kind of discriminate them is, the testing. The first test, that's going to be what's called the average deferral percentage test. And what it actually does is it limits how much high comps can save of their income. And what we have to do is we have to look at all of those other employees that are eligible for the plan, calculate what their average deferral rate is, and the IRS only allows the high comps to actually save about 2% above that average. So let's say hypothetically, if you have a company and everyone signs up for 3%, well, you have an average of 3, and that means that the passing rate for your high comps is only 5% of their pay. So your non-high comps, they can save up to the 19,000 or 25,000, but if you're a high comp in a 401k plan, you will be somewhat limited as far as how much you can be saving. Now, there's another test that's performed on 401k plans at the end of the year, and that's called the top-heavy test, and that looks at the assets. Well, who has the money in the plan? And if 60% or more of the plan assets belong to those high comps, those key employees, you're in what's called a top-heavy situation. And when that situation occurs, that actually requires that the company make a contribution to the employees that equals 3% of their pay. So plans that are top-heavy, it's basically forcing a company to give everybody a 3% bonus. And then, when you're thinking about all this, if you're a business owner, it'd be like, well, hey, if I'm a business owner, if I'm going to be restricted as far as, how much I can save, based on what the employees are saving or not saving, and I might have to make a contribution to everybody, why would I be offering this and why would I be doing these types of plans? So the plan design, it's really going to come down to what are the goals? If you're a business owner, if you're maybe looking at putting aside a plan that's going to, provide your employees a method to put aside and get tax benefits from their savings, yes, it's a good option. But if you're a business owner looking to put aside a substantial amount of your income, you're going to be subject to some testing, but there is a plan design that will eliminate the testing for highly compensated employees. And that's what's called a safe harbor 401k plan design. So we have a lot of companies these days where, it's a business owner is looking at maximizing the benefit for himself, but you can't just offer it for yourself. But what this safe harbor design does is going to eliminate the average deferral percent test. It's going to eliminate the top-heavy test. So even if you have 0% participation from employees, high comps would still be able to put aside the maximum limits. But to satisfy the safe harbor conditions, there is a required company contribution. And there's basically kind of 3 different options that I'll explain quickly. You've got 2 that are matching, where if the company is matching, remember, that's only going to go to employees who participate. So if you do this matching, it does need to be very specific. It needs to be like a dollar-for-dollar match on the first 4% of pay that employee saves, or you can formulate it a little bit more confusing, but you can do a dollar-for-dollar match on the first 3% and 50 cents on the match on the dollar on the next 2. So with this second formula, it's encouraging employees to actually save 5% of their income. Because if the employee is saving the 3 plus that next 2, if the employee is saving 5%, the company would be matching them 4%. Under this first matching formula, the employee, if they just put in 4, you match them 4. So we do have most companies will choose one of these provisions for safe harbor, but the other is what's called this non-elective, And that's where, a company would automatically just make a contribution that equals 3% of everybody's pay, and, everyone who's eligible. So we'll have, maybe a small percentage of the companies, will go with this non-elective, but that's a nice plan design in that, some companies might say, hey, we want to give a contribution to everybody, regardless of their ability to save or not save. So that could be one reason why companies choose this method. A lot of other companies, though, they'll go with that matching, really just to try and incentivize employees to save. Because if someone's saving, 5% of their pay under this scenario, and then the company is putting in 4%, well, that employee has 9% of their income being saved, put aside each year. So that's a nice path to a comfortable retirement. So, a safe harbor plan design, that could be a really good fit for many businesses where, if you have highly compensated employees that, again, those are usually the ones who are, the higher paid employees and the ones looking to contribute more. But it can be a really good plan design because it will allow them to max out. But at the same time, it's also a nice benefit plan for everyone who's participating, or eligible if that contribution is elected. So, just another option that's available within 401k plans. Now, kind of how does all this work? There's actually, kind of a lot of companies that are going to be involved and responsible for a lot of different components on the 401k plan, and I'll kind of explain these different, roles and responsibilities. But you'll have a third-party administrator, that could be, Fidelity, Mass Mutual, Slavic, John Hancock. You'll have a company that's, the custodian, the record keeper, providing the statements. But you'll also have an investment advisor, sometimes that's a local broker. So, kind of the 401k services could be like 3 different parties right here. But then the company is actually going to be the sponsor of the plan, and the administrator for the plan. And then each plan is also going to have like a designated trustee. So to explain kind of the roles of the third-party administrator, they're basically the ones in which, hey, they'll go through the plan design and say, yeah, based on, kind of our discussions, here's what, would be a good plan design for you, the eligibility requirement, safe harbor election, discretionary profit share, but then they'll be providing the plan document that, stipulates all of those different, requirements and guidelines. But then there's also a tax return that needs to be filed every year on 401k plans. That tax return is going to, basically say, oh, here's when the plan was effective, here's how many employees were eligible, contributions, and so forth. But your third-party administrator would be preparing that 5500 filing each year. And then I'm going to just do a simple mute here. And I'll open it up for discussion later. So just remind me to unmute anyone if so. But the third-party administrator will put together the plan documents. They're also going to prepare that 5500 file, each year. And then they're the ones that are responsible for all that boring stuff behind the scenes, that average deferral percentage test, make sure that the employees didn't contribute too much, looking at top-heavy scenarios and so forth. But then another, kind of big, work that's involved is on the distribution side. Plans these days, they allow employees to, borrow against their accounts through loan provisions. So if the plan has a loan provision, your third-party administrator will do all of those amortization schedules and so forth. But also they'll be processing, final distribution payouts as well as rollovers. So your third-party administrator is going to be doing a lot of work that's associated with the plan, and they'll be providing kind of guidance to the plan sponsor. Because a company who's offering the plan might not have any familiarity with the rules of 401k plans, so they'll go to their third-party administrator or investment advisor for assistance and information. Then the custodian and record keeping, well, that's where the money sits, and it's where all of the contributions are going to be processed into the employees' accounts. So those contributions are going to be, the employee deferrals, any employer matching, profit share, money that employees might roll over from a previous plan, providing the accounting on the loans. So it's your custodian who's, holding all of this and doing the accounting on all of these balances. And the custodian will provide, the breakdown as far as balance by individual fund, that each employee has selected, They'll also provide, balance by how much you've got in Roth, pre-tax, rollover money, loans, and so forth. And then they'll also be providing the performance of the accounts as well as generating statements. And most custodians, they provide statements at least on a quarterly basis, but most of the custodians these days, they have daily valuation. So at any time, if an employee wants to see, the balance in their account, you can simply log on to the website, check your balance, and usually make almost any changes or transactions right through your accounts through their website. And most of the custodians, they're providing these kind of breakdown and accounting at the individual participant level, as well as the overall plan sponsor level. So plan sponsors can see, total plan assets, how many are eligible, and so forth. Then you have the investment advisor. And the investment advisor's role is basically to determine and suggest what are the funds that should be offered and available to the participants. And so most 401k plans these days are comprised of mutual funds. It could be Fidelity, Oppenheimer, Vanguard, Mass Mutual. But the investment advisor comes up with that recommended lineup. And they'll usually have an investment policy statement that says, okay, in order for it to kind of qualify as a fund that we're going to offer, we need to look at how that fund is compared to the other funds that have a similar investment style. Let's also take into consideration, what is the management fee of that particular fund? How does that compare to the other funds that have that similar style? And then who the manager is of that fund. How long have they been managing it? Do they have a lot of turnover within that fund, as far as are they doing a lot of exchanges and redemptions, and do they have style drift? So all of this should be taken into consideration when it's coming up with that recommended lineup. And then the investment advisory team, they'll usually meet with the plan sponsor on an annual basis to provide a review. Hey, here are the funds that were offered within the plan. We've compared these and scored these against all of the other plans and or all the other funds that are out there. And your investment advisor would usually make recommendations as far as, hey, we should maybe replace this fund because there's other funds that have outperformed it, or maybe there's a certain type of fund that has done a lot better, or a sector-specific type of fund that we should maybe add to the platform. So that's kind of done at the sponsor level typically, but some investment advisors, they might also offer their general services at the participant level, for general investment advice. So, we can assist employees as far as helping them decide what type of investor profile is suitable, what's their risk tolerance, should they be aggressive, moderate, or conservative. So general investment advice is, oftentimes offered by the investment advisor. And within the plans that Slavic provides all of these bundled services for, we are the investment advisor to the platform. So we're making the recommendation of the overall lineup. But our investment lineups are usually comprised of about 30 different funds, but they're all through, some of the most publicly traded funds, Vanguard, Fidelity, American, and so forth. And all of these platforms, once the fund lineup is made available, each participant would be able to select, do they want 100% in one fund, 10% in 10 different funds. But the fund lineup will range from, conservative or money market type of investment choices, all the way to, very aggressive types of funds. So whatever, someone's investor style, if they want to be ultra aggressive or ultra conservative, there should be an option available for them within the plan. And then, we also have what's called the target retirement date options, which are kind of an easy way for a lot of employees to say, hey, I'm looking at retirement in 2020. They can just select a 2020 target date portfolio, and it creates a diversified mix of funds for them that would gradually become conservative to that time that they've selected. So, a lot of different investment choices are available at the participant level, but, there's 17,000 different funds out there. So it's your investment advisor who will, scan, condense that, because no plan is ever going to offer 17,000 funds, because they'd have to be reviewed annually, and then it creates, a lot of confusion at the participant level. But your investment advisor will be responsible for that overall lineup. Now, the plan sponsor is, the company who's deciding, hey, we want to offer the plan, and here's how we want, the plan design to be made. But as a plan sponsor, you're kind of also administering the plan. And so there's a lot of stuff that goes on with administering these 401k plans. But on the administrative side, it's calculating how much the employee is wanting to save of their paycheck. If there's a matching formula, calculating that matching formula, if employees want to increase or decrease their contribution, putting that into the payroll, as well as any loan repayments. And then, once all that is set up into the system, well then, as the administrator, you're then responsible for, sending that money over to your 401k provider. So that's what's called like a contribution report. And with that contribution file, you usually should be providing your third-party administrator with a complete census data, employees' hours, date of birth, date of hire, termination dates, and so forth. So, on a kind of a payroll by payroll basis, there is quite a bit of administrative responsibilities involved. But then there's also some notice requirements. If a company has a safe harbor plan, got to send the employees a notice every year, provide them that notice that they're eligible for the plan every year. So these are just different responsibilities kind of at the plan sponsor administrator level. But then there's kind of one person or maybe the company that has ultimately the liability for this. And that's commonly referred to as the trustee. So the trustee, and it's usually like a CFO of the company, controllers of the company, and it's their responsibility basically to say yes or no for the fund lineup. Your investment advisor will, provide the advice as far as maybe which to replace or add, but then the trustee says yes or no, and we're approving that. But then it's also the trustee's responsibility to make sure that that 5,500 is filed. The third-party administrator will prepare it, but then, the plan sponsor trustee needs to file it with the Department of Labor. And then anytime a company is sponsoring these types of 401k plans, this is employees' money, that you're usually withholding from their payroll. So there's ramifications as far as if you don't send that money to your provider in a timely fashion, if you don't start the deductions when the employee had requested and that they were eligible. So, employees these days, they can sometimes go and they can file a lawsuit, against their, company and say, hey, you didn't get my money in a timely fashion, you didn't give me, suitable investment choices. So the IRS requires companies that are offering these plans to have some ERISA or, what's called insurance bond coverage. It's a small expense for them, but it just kind of protects employers and, trustees as far as the overall, offering and, operation of the plan from an administrative standpoint. Now, another requirement is if a company has more than 100 employees eligible for their plan, you could have 100 employees eligible, but only 2 in the plan. But if you have 100 eligible, the IRS says, well, you also have to have that plan audited every year. And that has to be an independent company. Your third-party administrator, broker-dealer, custodian, they can't self-audit. So it has to be another company that's auditing the plan. And the audit fees these days are close to about $12,000. So, companies, you're able to provide these types of plans with the employees, but it can sometimes be an expense, associated with offering these types of benefits. So, the responsibilities that come into play, as well as some of the workloads that come into play, that's where, companies will say, is this worth it? Is this not worth it? Maybe we shouldn't, go forward with a 401k. So, a plan design, it is important. But one of the advantages that you have as far as offering these types of plans would be through Excel. Excel, they sponsor what's called this MEP or multiple employer plan. And many companies like Excel in the country, they have these similar types of plan designs. But what it does is they actually have a master plan document. And Excel is the sponsor of the plan, the administrator for the plan, they're the trustee for the 401k plan. So they're assuming those responsibilities. And so that takes the kind of the burden off of you as a company, because Excel, you're running payroll services with Excel. So they're going to be calculating the deferrals, matching if you have a matching formula, loan repayments and so forth. That's all incorporated into Excel's payroll. Excel and Lori and her team, they're the ones who are going to be doing the contribution file directly to us. They're providing us the census data. They're also providing the annual notices. Excel provides the ERISA bond coverage as well as the annual audit. So you as a company are not responsible for those types of services. It's Excel HR who is providing all of those functions and services, which does remove the clients that adopt onto their plan from being a fiduciary and those types of liabilities. But it's then Slavic, who's doing everything else. We're the third-party administrator for the plan, record keeper custodian, as well as the investment advisor, to this multiple employer plan. And by being part of this multiple employer plan, it doesn't put you into a certain plan design. It does allow you, each company is able to customize their own plan design. So the features that you'd be able to customize with the plan would be, the eligibility requirement. Do you want the employees to work with you for a year, 6 months? Would you like immediate eligibility? So you first choose how long you want an employee to work with you before they can participate and be eligible. But then you also have the option, would you like to go with a safe harbor plan design? Or if not a safe harbor, would you like to do some discretionary type of matching contribution, profit share? You can actually have all of these. You could have a safe harbor plan that also provides a regular match and, profit share. So you can have all these different types of, customizations done within your plan. Another feature that's becoming popular is auto enrollment. IRS says, hey, a company, you can automatically enroll your employees. They don't even have to sign a form. And you can start withholding 3% of their pay, 4% of their pay, and have it, deposited into an account for them. So, what they've seen is, many people aren't, they're not maybe proactive, but that auto enrollment feature, it automatically gets it set up. But then employees do have an opportunity to opt out, or certainly change their contribution amount. But you can choose all of these different, features and, customizations within each of your plan design. So, it hopefully is able to, within the IRS rules and regulations, it allows the company to maybe, create the plan that's going to, work for the business's needs, as well as, a plan that's going to satisfy the employee to be able to save and plan for their own retirement. Now, all of these different services that are being performed within 401k plans, regardless of who the third-party administrator is, the broker-dealer, the custodian, they're all going to be compensated for their services. And that's one of the ways in which, we kind of look at, okay, all of the business that's with Excel HR and through our bundled approach, we're typically able to, provide all of these 401k services at much lower than national average costs. So a lot of companies, if you're a smaller business, you might have looked at a 401k plan before and said it might not be worth the expense, because kind of national average, you're looking at, as far as a setup fee, you might be, $1,500 for the plan document. And then each year, national average, you're looking at about $1,750 for, the compliance testing and the preparation of the 5,500. But through Excel, by them sponsoring this multiple employer plan, and through kind of the economy of scale of all of the participants and worksite employers that are part of the plan, we are able to do all of these services at lower than national average. So kind of from an employer perspective, what you'd be looking at is a one-time setup fee of $500. And then on an annual basis, the company would be responsible for a charge of $350. And if you happen to have an existing 401k plan, yeah, you kind of know what you're paying. It could be $3,000 a year if your company's with paychecks. So, if you do have an existing plan, we would be able to merge those existing plans into this plan. There's a lot of work and due diligence that's involved with plan mergers, but there is a small additional fee that would be applicable in those instances. So this would be kind of just company charges alone. And then at the participant level, each employee who has a balance within the plan, the employees have a $20 annual administrative fee. That's covering general customer service and statements. But then, that's going to be broken out. It's like $5 a quarter. But then they're also going to have like the custodial fee, okay, to do all of the accounting, the reconciliation for all the trades and transactions, the valuations, and so forth. Most providers out there will either refer to their charge as an asset fee or a contract charge. And it's a percent of the plan assets. But there's what's called breakpoints. And the breakpoints are like as company plan assets increase, these asset charges or contract fees decrease. But what ends up happening is in the Excel plan, as well as most other plans out there, you'll have like a maximum of, let's say, 0.85%. And as plan assets are increasing, there might be a decrease to where, oh, if you reach 600,000 in assets, it reduces. At a million, it reduces. But the asset charge can go down to as low as 0.25%. But that would be based on each individual client's participating employees. So ultimately, what's happening with this asset fee, though, is the employees aren't directly, they're not paying a check and they're not being billed directly for this, but it's built into their account. And so it'll kind of have the effect of reducing their overall performance by these amounts each year. So if you choose a fund and the fund does a 10% return for the year, at that 0.85 asset fee, you ended up with a 9.15% return. So and those charges have always been there, but it didn't really have to be fully disclosed until about 2010. But it depends on how the provider is disclosing it. Do they show it on statements, or do they disclose it on an 18-page document at the end of the year? But they're kind of all built into all 401k assets. And then you're also going to have the individual funds. So the funds that the employees are choosing, if you're in a fund with Vanguard, it's going to have a certain expense ratio. If you have a fund with Fidelity, it's going to have a certain expense ratio. So, there's kind of these administrative charges, at the employer and participant level, that custodial type of charge for the record keeping, and then, the underlying investment choices. So, together though, with all of these types of, charges, when you add them up, most providers are going to say, okay, well, for all of our administrative services and record keeping and so forth, the total fees might be 1% of, 1% of plan assets, 2% of plan assets, 1.5% of plan assets. So it kind of gives it to an overall comparison. And together with kind of the funds that we've offered through the Vanguard, with their low expense ratios and their primarily index funds, and then these different breakpoints that we have and these lower administrative charges, we're usually much lower than the national average, which can save thousands of dollars a year as plan assets increase. And that could be hard cost savings at the employer level, but primarily a lot of times it's on the participant level. But to kind of give you an idea as far as what these overall types of fees and how it can compare to national average, there is a company, and it's a book that's published every year. It's called the 401k Averages book, and that takes into consideration and all the different research that they do. What's the national average administrative charges? What's the national average record keeping, custodial, mutual fund expenses? So they'll actually come up with a certain percentage. And what Slavic is actually able to do is we can look at all the companies or any company out there that if they have been sponsoring their own plan, well, they're having to file that 5,500 tax return every year. And that 5,500 tax return, it's public information. So we can look at those 5,500s and see, well, for each company, how many employees did they have eligible? What were the contributions that were made? What are their total assets within the plan? And then that 401k Averages book, that will say, okay, for a company that has approximately this much in plan assets with approximately this number of eligible participants, this is the total expense on a national average. And again, that total expense is the underlying mutual funds, asset management fees, record keeping expenses, administrative charges that the company as well as the employees are paying. So for a company that has $2.5 million in assets, national average is about 1.24% a year of those, that plan assets. If this plan is on the Excel HR platform, we've got those breakpoints, so the asset fees decrease and low administrative charges. The total expenses for this plan to be on the Excel platform would be 0.64% a year. That equates to about a $15,000 lower in overall fees compared to the national average. This other plan, that's kind of right in the same line, same ballpark. That one has that national average of 1.24. Our expenses would be 0.65. This plan, I think the reason why this one's a lot higher is because they have so many more participants eligible. But national average would be 1.42. This plan 0.64. So in almost all instances, to be part of the multiple employer plan through Excel would actually be about 50% less in fees, on the funds, and again, overall charges. It's not like the company is paying, and the company is not going to necessarily save $15,000 a year. It's just going to be $15,000 in overall lower charges, from those funds and record keeping and so forth. So the value that you get through Excel HR and their multiple employer plans, cost savings at the employee as well as the participant level. So it can certainly be a good thing to consider. Now, whenever we're looking at putting these plans in place and companies considering, who their provider is going to be and so forth, the primary objective is, offering these types of plans for the employees, and sometimes it's becoming a necessity, these days. Hey, employees might be looking for you, and one of their first questions might be, do you have a 401k plan? What do you match? So, sometimes it's a need for employers to offer these types of plans, but it is important, if you don't have a plan, when you're looking at designing the plan, how it's going to be, attractive for the employees to be saving. Is that going to be through matching, safe harbor options? But, ultimately the goal is, you want everyone to be hopefully satisfied. You want the employees to, be happy with the retirement plan that's be putting in place. You want the employer to be satisfied with, services that they have to be performing and so forth, and expenses that are associated with it. But, the value that you get through the Excel multiple employer plan is you can customize the plan. Myself, as well as our consultants, we work with the company to kind of come up with that overall plan design. But, at the same time, you can usually have overall 50% lower expenses by, going out there and sponsoring your own plan, and then not have to have those administrative or trustee responsibilities. So it could certainly be something to consider. If you have an existing plan, maybe take a look at the Excel HR plan. And certainly if you don't have anything that you have in place right now, maybe considering, offering and speaking with one of our representatives. So that kind of concludes, the overall, what I wanted to kind of present to everyone today. But what I'd want to do is just kind of open it up for, question and answers.